As we pivot to the US, obviously we always like to look at this chart and you can get an idea of how you had that steep drop down and you had a bit of a recovery because obviously, as we said last week, 13.45 million barrels a day of demand was too low. And we said we were going to get to closer to 14.4, that we were going to see some of this in general and we were going to get some of this bounce back up. But you could see it's still running actually below where we were in 2022 and in 2021. And so we still don't see a really meaningful side. And given like when you look at 22, which is interesting, it's just essentially shifted to the left. But we're not going to get the same, that we got that spike. You can see it was a little bit, lower high, higher low. And it's just tightening up a bit because in 22, especially now, we had some of that support from the trucking side. We're not getting that kind of support at this point. Now things are starting to fall off a bit because you have gasoline that's down. Gasoline was stronger in 22, and you had distillate that was strong but falling. Here we're just weak and just staying weak. So that's where we're getting some of this pressure on why, as we've been saying, we're not going to get to that 15.5, 16 million barrel a day demand front. We're just going to stay in this 14.5, probably get up to closer to 15. But when you look at 21, you had that trend up, and the trend up was driven based on, you had pretty aggressive buying in gasoline as people were tired of lockdowns, but trucking went ballistic as you got towards that end of the year. And again, as that happened, you had a lot of that support, which really helped pick things up. Now, before we get deeper into the show, we were I was in Boston with my wife on Monday. We were visiting a potential investor for C6. And it was good because then we met a friend who's fairly high up in a very large, one of the largest hotel chains. And I was just talking about what we were seeing, that, traffic wasn't bad coming up. And she said that, across the brand, that average stays are down year on year, 12 to 15%. And she was like, in her specific location, they're outperforming and only down about 8%. But she was like, there isn't a spot within the franchise or franchises that are not seeing a sizable move down of double digits on average across the brand. And that's, again, it's comparable to what we were talking about in the econ show, where we're just not seeing the same level. We showed it from an Airbnb perspective. We've showed it from multiple perspectives. And as we said, the driving data is reflecting that. The credit card activity, which has now gone negative, Red Book on retail stores is now red again. And you're seeing that pressure as all of this culminates and showing that pressure point, which we're going to talk about in more detail tomorrow in the econ show when we look at the consumer and some of those issues in general. Distillate, had that small build of about 10,000, and you can see it's still 19.6 below the 5-year. But Pad 1 is the driving force behind that. Pad 1 is still 15.4 million below the 5-year. Pad 2 had a small build of 590,000. But there's a lot of this unknown when you look at Chicago, because a lot of flow went from Pad 3 into Pad 2, but now it's stuck. And you saw diesel prices get absolutely crushed in Chicago. They've started to bounce a bit, but again, there's this weird backdrop right now in terms of where the volumes are, especially as you get refiners utilization rates going back up. Pad 3 had the build of 630,000 barrels. That's going to be the one to watch in terms of exports. The ARB is now back open. That's going to help our exports going into into Europe. So that's going to be a positive. But again, at the same time, at these crack spreads, guys are going to run as hard as they can. So you'll still get that crude getting put into the distillate pool. And then our imports are going to stay fairly low and fairly consistent here just because of the competition that we see in terms of where the volumes are headed. So then when we start looking at this point, you can see on the storage level, it kind of flatlined. The build was a bit slower than what is seasonally normal when you look at the 29-year average. And you can see we're still not at a very good point, which is why you still are going to get a decent amount of margin. And that's when you start looking at the crack spread. It's continuing to strengthen, which is going to incentivize refiners to run harder, run a bit of that heavier crude that we've talked about, and trying to target this piece, because the gasoline side on a global basis, a lot of gasoline, not a whole lot of demand, and that's going to keep this part of the barrel, pretty much the end all and be all. As you look at pad 1, that continued to see some of these pressure points. You can see here that 2022 continues to run. 2023 is running right along 2022 levels. We were lucky last year with a warm winter. Maybe El Nino provides the same gift and we have another warm winter. But unless we get some meaningful shift, there's going to be a problem at this point in time. Pad 3 trending back up. We're getting back to the highs of 2023 for storage. We're well above 2022 at this point. We likely won't see 2022 numbers again, just because we're going to see a bit more of this elevated level. We will get a bit more exports, so that'll help keep us a bit even keel. But we don't see huge draws. We don't see huge builds. If I had to say which direction do we go in, we'll probably see some steady builds at this point. But again, small, not huge, and it's all going to be driven. I mean, at this point, you can get a massive ARB open, and then they'll send as much as they can. But again, you have to manage that, and that's what they're going to continue to do in Pad 3. When we look at the demand side, you can see that seasonally speaking, you get that drop off, you get the recovery. We're still going to stay below the 5-year average, especially when you start looking at where we are. You have a lot of potential strikes coming up. Yellow is likely going to fold. UPS is trying to avoid a strike from the Teamsters. I mean, you're looking at almost 22,000 truckers that could be taken off the road. So there is a lot to look at when you start talking about distillate, where that distillate demand is, and that is going to be a sizable hit. When you start looking at office space, the vacancy rates, national office vacancy rate expected to rise, and market rents are expected to continue to trend down. As we've been saying, most places, if they're lucky, they're between 55 to 55% of normal. If you're in more of the harder hit places, you're closer to 40, 45%. So again, we're just not getting weekday traffic. I mean, that's just what it comes down to. The flexible schedule is there. This is what we've been talking about, and why we don't see those driving points coming up. Here you can see more slowdown in the trucking market, as we talked about 21 into 22, and now you're starting to see that slow down. And as it rolls over further, we're also not seeing a huge amount of trucking. Things are trying to get, and this is with things trying to get pulled forward ahead of a potential strike, and we're just not seeing a huge amount of volume. We did see a small pickup on the rail side. Total carloads came in at 0.9. Chemicals are at 1.6% above, but grain, again, under pressure because of yields. Motor vehicles still strong, non-metallic, petroleum still strong. Intermodal bounced. It was down about 7%. Now it's only down 5%. So that was some of that additional, but again, we're still going to be below 22, and we don't see much additional going on intermodal. Now that could change, especially if we get a meaningful trucking strike. That could put more on the rail system, but again, that would then take away a significant amount of flow from the trucking side. So you're not going to consume that amount of diesel on the rails front. So it'll still be a big slowdown. Activity coming into the States, again, very manageable. There's not a huge surge. As we said last week, Taiwan exports are down, South Korea, Japan, India, China. Again, you're getting this slowdown that continues to accelerate and pick up steam as we look through the next few months. We're going to get some decent heat. It'll be good for natural gas when you look at some of the different flows. As we talked about, the heat dome continues to move around. It's going to be sitting over Nevada and New Mexico. When you start looking at how it's pivoting from Texas coming over to New Mexico and then peaking slightly into Nevada, wouldn't want to be there right now. That's for sure. I mean, East Coast is going to get a little bit warmer, but you can see it's a bit more manageable in comparison to the west side of the country. So again, this will be good for natural gas demand and that power burn as people turn on their ACs. Gasoline had a draw of 1.06 million. That's 18 million below the 5-year, 10 million below year on year. PADD 1 had an increase of 570,000 barrels. There was a bit of a slowdown in imports into PADD 1 of 135,000 barrels a day. When you look at it, we're still only 64,000 below the 5-year average holistically, and that's when we had a small drop of 63,000 barrels a day coming into all of the U.S. because we did get an increase into PADD 5. The biggest thing is we will get that bounce. The question is always, and this is my problem because I'm looking at the boats and it's like I can see them coming. It's just a matter of when do they get recognized? When do they pull into port? When do they get? When does the paperwork get filed? When does it show up in the storage? So again, those timing delays, I can just tell you it's there, it's coming through, and not that PADD 1's gonna import over 1 million barrels. It's just we're gonna be closer to that 850 number, which is going to pull up our gasoline imports. And again, that's going to be one of those spikes because you can see in 22, there were two weeks of these consistent increases, and that was all imports. Demand was obviously a bit sluggish, but that was an imports driven thing. And that's something that we've been talking about. We will get that, which will provide kind of that counter seasonal build. But we normally do get those increases that we talked about from July 4th in demand of July 4th to August 15th, which is why, storage normally drops. But we're seeing some of those pressure points in general just because of demand, because of the amount of imports we do see coming. Blending components was up 780,000 barrels. There's, as we talked about, a bit of that disconnect between the two. So we want to look at, as we said last week, finished motor gasoline was elevated, blending components was down. Now that's flipped. So you're starting to get some of this balancing act on the blending side. And I think because some stuff was blended a bit early, with the expectation was going to flow out. Now you're starting to see that, and we're starting to get into a bit more of a steady state that we're used to seeing, even as demand continues to slow. Blending components, small build, you can see here, still on a fairly bullish side. But one of the things that we've been talking about is it's going sideways. And you can see that there's a nice drawdown that happens, in the previous 7 years that we think that as this goes sideways and those storage numbers come down, you're going to essentially run right into, easier comps. And that's because of the slowdown in demand and the struggle that we see continuing on the petchem side. When we look at activity, Asia Pacific had a small bounce, but we don't see it going up too much more from here. Europe continues again to slow, but we don't see it slowing further, just kind of leveling off right at these levels, as we do expect North America to get back to kind of what we're expecting right before July 4th or right at that July 4th level. Gas Buddy expected gasoline demand to rise 1.8%. They modeled 8.82. When you look at what we came in at, EIA was at 8.85. So right around this point, we do expect to see another increase. Gas Buddy, I think they have another 1.2 increase so far between Sunday to Tuesday, which makes sense. Remember, we're going to keep kind of having this lockstep. We're just not getting a 5% increase. It's a bit more sluggish or a bit slower than what has happened in the past. So, and a lot of that is driven based on pricing. Going back to 2018, you could say, adjusted for inflation. Well, adjusted for inflation, people's incomes are also down. So when you look at it, you're starting to level off here, and that's $3.56 on average throughout the U.S. That's a big number, and again, that's going to keep people a bit slower and not moving to the same degree. Which is why when you look at the demand side for crude, for gasoline, we expected a bit more of a stronger increase. Instead, it went a bit more sideways. We will get that snapback. We're just saying that the snapback is going to put us right at the average, the average, which is closer to about 9.1, 9.2, and we don't see going much above that, given those headaches that we've seen for the consumer and underlying spending. Propylene had a build of 890,000 barrels. It should build, but you can see the rate of change is still elevated. It's still higher. It's still the highest it's been going back to 2015, and we don't see that changing given the amount of production we have on the NGL front, as well as that slowdown in petchem internally. The only thing saving us right now is our LPG exports. Jet had a build of 580,000 barrels. You can see it's pretty much in line with the 5-year, year-over-year. Demand, as we were saying, 1.55, 1.65, right in line with what we were expecting. When you look at flights, we're at the point now, because looking out 12 weeks, it's set to fall 0.4%, which is normal, because you have the increases going into summer, then you have those declines, again, seasonally normal. When we look at flight cancellations, still remaining fairly elevated when you look at some of the impacts. And then for TSA passengers, as we've been saying, it's just tracking 2019 levels. Some people have talked about there's more flights, but right now there's not any more passengers. And then there was something where the U.S. is sending a ton of people to Europe, or a lot of people are going to Europe. That may be the case, and that may be helping, because maybe if the U.S. wasn't sending more people to Europe, this would be way worse. But right now, Europe is still, in terms of Eurocontrol movements, we're still below 2019 levels. And then on an eating out level, still down. U.S. is down 2 to 3%, globally down 1 to 2%, and that's something that is a trend that we see accelerating to the downside, given the pressures on eating out and just, again, consumption and the consumer pain. So that's what we have for you. Again, not too bullish. You could say this is more neutral and you want to wait for more information. I'd say this is a bit more bearish, given how we kind of see things going forward, especially that we should be in really peak travel time, and we're just not seeing that level of activity. So that's what we have for you on that segment. In the next segment, we're going to go deeper into global movements, global flows, and we'll cover more from that perspective.